Next, we're going to take a look at the costs of merchandise inventory. We just ran through those in our practice sets. Let's detail that out a little bit more. The costs that we include are all of the costs to get the inventory ready for sale. This includes the invoiced or acquisition cost, less any discounts, plus other costs, which might include shipping, storage, insurance. We saw where we might insure the goods during the shipping process, doesn't include insurance that we might pay after, and our import duties. At the end of our accounting period, we will make sure that the goods that we say that we have on hand are actually physically there. So we will do a physical count of the inventory at least once a year. Most companies actually do this more. Some internal controls that we have over the inventory count. Now, internal control is something that we mean that we're controlling the environment, we're controlling how the process works to minimize error and minimize the chances for corruption or theft or um, misleading information. So some of the ways that we might do that is we'll probably use pre-numbered inventory tickets. We will have counters that don't have any responsibility for the inventory. They don't do the purchase orders. They don't move the inventory, etc. Counters confirm the existence, the amount, and condition of that inventory. A second count is taken by a different counter, so another counter will come behind and verify the count. And the manager confirms that all items are counted only once. So the manager will walk through the warehouse or wherever the inventory is held and make sure that it's only counted once. Once we've done the count, now we have to come up with how we value that inventory. We have four methods we use to assign cost to inventory and a cost of goods sold. The first one is specific identification, and that one is obviously the most accurate. There we identify the goods, we know what we have left, we know what we sold. We specifically identify every good that we sell and match it up with the cost. This works for large ticket items like automobiles and maybe some antique furniture. It doesn't work well for, say, bicycles or smaller ticket items, clothing, etc. There we're going to group the items together because it isn't worth our time or effort to do the specific identification. The cost outweighs the benefit. So the other methods we'll look at for those valuations are what's called first in, first out, FIFO, last in, first out, LIFO, and weighted average. These are the four types of inventory costing methods that we have: specific identification, FIFO, LIFO, and weighted average. You'll see the pie chart here that shows the most common use is FIFO because FIFO results in the greatest net income. Which leads us to the discussion about inventory cash flow. Inventory cost flow assumptions say first in, first out says the first item that I brought in, the first purchase, is the first one that I will sell. So we go through our inventory until we use up all of the first goods, then we go to the next layer, the third, etc. Last in, first out says I'm going to start with the most current inventory. So when I sell something, I'm going to go back to my most recent purchase and remove that from inventory. Weighted average says every time I make a purchase, I'm going to come up with a new average cost of my inventory, and that's how I'm going to value the ending inventory and the cost of those goods sold. Now remember the cost flow of our inventory. We had beginning inventory plus net purchases equals merchandise available for sale. That merchandise available for sale either goes to the balance sheet as ending inventory or moves over to our income statement as cost of goods sold. We're going to take a look in the practice set now at the valuations using those costing methods. So the first one that we're going to do, we're going to take a look at the FIFO. Let's just back that up a little bit. So we're not going to go to the practice set quite yet. Let's look at our inventory costing under our perpetual system. We have our balance sheet ending inventory and the income statement cost of goods sold. The physical flow does not need to follow the cost flow. Here is an example of a perpetual costing system. We've got our beginning inventory, units acquired at cost, our purchases, and then our sales, purchases again, so our units available for sale, goods available for sale, units sold, and our units left. And we need to determine how we value both the cost and that ending inventory. So we come up with here's a specific identification method, the perpetual, a total cost of 55 units available for sale, and then our cost of goods sold, we specifically identify the 8 units that were sold at $91 and 12 units that were sold at $106. On August 30th, we had 2 units at 91, plus 3 at 106, plus 15 at 115, and 3 at 119, for a total of 2582. So total cost, goods available for sale, 5,990. We specifically identified which ones were sold, remove them, subtract that from our goods available for sale to determine our ending inventory of $1,408. So now let's go take a look at how does that specific identification work in our practice set. I'll ask you to work through that on your own and then come back. So we're going to do QS 5.3, QS 5.13, and exercise 5.3, but only number 1, the specific identification part. The first problem that we're taking a look at is QS 5.3. We have Watt & Company reporting beginning inventory of 10 units at $60, and then it gives us the purchases every week for the next 4 weeks, weeks 1 through 4. We are asked to compute the cost of goods available for sale and the units available for sale for this 4-week period, and we're assuming that no sales occurred. So what we do here is we just fill in the information. We had 10 units in beginning inventory at $60. We'll do our extended value. Extended value means the units times the cost. So units times our cost. And I'm going to go ahead and copy that all the way down because I know that I'll need that formula for the next week's. I'll take it out of this plus area because that's not a calculating cell. Now for week 1, we purchased an additional 10 units at $61. Week 2 is 10 units at $62. Week 3 is an additional 10 units at $65. And week 4 is 10 units at $70. The question asks us how many units are available for sale. 50 units are available for sale. What is the cost of those units available for sale? $3,180. Now, as we start to sell those, now is when we need to make the determination, what method we will use to value both the cost of the goods sold and the goods that are remaining in ending inventory. In QS 5.13, we're to refer to the information from QS 5.10, and we are to value the cost of goods sold and the ending inventory based on the specific identification method. And it tells us that our purchases, and in this information of the units sold, it tells us that 8 are from the December 7th purchase and 7 are from the December 14th purchase. So let's start with, on December 7th, we purchased 10 units at $6 each. So again, we're going to do that extended value equals 10 times 6, and we're putting this under our goods purchased. Over in our inventory balance, then, I've got those 10 units. That's all I have at this point. And at $6, and again, my extended value. So after December 7th, that is my inventory balance. On December 14th, We purchased 20 units, so I'm going to purchase an additional 20 units at $12. Extend that out. Now my ending inventory, I still have these 10 units. I haven't sold anything there. So I'm going to bring that all down. And I also have these 20 units that I just purchased, so I'll bring those in. And multiply that out. Now on December 15th, what happens? I sell 15 units. And it tells us that of those 15 units, if we go back to our problem, we sold 8 of them from the December 7th transaction. So I sell 8. Now I'm in my cost of goods sold, right? From this December 7th group, which had a cost of $6. I'll extend that out. I sold 7 from the December 14th purchase. So that's this $12 group. And I'll extend that out. Now, what do I have left? I had 10 from the December 7th purchase. I sold 8 of those. So 2 of those remain, right, at $6. I sold 7 of this group in the 20, so I have 13 of those left. And now on December 21st, I purchase an additional 15 units at $14. So now my inventory, I'm just going to, I have all of this left still, right? I'm going to copy this and bring this down. So I've got the 2 at 6, I've got the 13 at 12, and now I also have the 14 or the 15 at 14. I'm going to go ahead and copy this down. Now because I copied, I wound up with a border there that I don't want. So I'm going to just get rid of that and say no border. Okay, everything should be totaling properly. And so the units that I sold were 15. They have a total cost of $132. So of my goods available for sale, $132, 15 units were sold. $378, 30 units remain in ending inventory. In exercise 5-3, I've recreated the information that you need for the purchases and the sales to value the inventory using the specific identification method and the cost of goods sold in number 1. So we don't have a lot of time remaining on the video. They're limited to 15 minutes, so we'll go ahead and get started. The goods purchased, I bring in my beginning inventory of $140 and $6 cost, extend that out, and that becomes my inventory balance at the start. On the 10th of January, I sell 100 goods, so I don't have anything other than those goods that are in my beginning balance, so I know that those 100 units come out of this group. So I'll take the 100 times 6, and now remaining in this group are 40 at $6 and equals 40 times 6. On the 20th of January, I purchase 60 units at $5.